Today we are covering annuity suitability requirements for the National Life Insurance Exam, which are governed primarily by FINRA Rule 2330 and the NAIC Model Regulation on Best Interest Standards. When you encounter these topics on your exam, you must realize that the burden of proof is on the producer to demonstrate that a recommendation was appropriate for the specific consumer at the time of sale. Under FINRA Rule 2330, which applies specifically to variable annuities, you are required to make a reasonable effort to obtain a specific set of customer information before making a recommendation. This includes the customer's age and annual income, as well as their overall financial situation and needs. You must also inquire about their investment experience and their investment objectives alongside their time horizon and existing assets. One of the most common ways this is tested involves the client's liquidity needs and risk tolerance. For example, the exam might present a scenario where a client has a low risk tolerance and a high need for immediate cash, but an agent recommends a long-term deferred annuity with high surrender charges. This would be an unsuitable recommendation because it ignores the liquidity and risk profile of the client. Another trap to watch out for is the distinction between suitability and the best interest standard. While suitability focuses on whether a product is a reasonable fit, the NAIC Model Regulation requires that producers act in the consumer's best interest, which is a higher standard of care. This means you must prioritize the consumer's needs over your own financial gain or commission. To help you remember the data points you must collect for the exam, think of the word LISTEN. The letter L stands for liquidity needs, while the letter I represents the annual income of the client. The letter S stands for their financial status and tax status. The letter T represents the time horizon for the investment. The letter E reminds you of their investment experience, and the letter N stands for their financial needs and objectives. If you have listened to your client and documented these factors, you have satisfied the primary gathering requirements. You should also be prepared for questions regarding the supervision and review of these transactions. Every variable annuity application must be reviewed and approved by a principal of the broker-dealer. A favorite exam point is the time frame for this review, which is 7 business days after the Office of Supervisory Jurisdiction receives a complete and correct application. If a principal does not sign off on the suitability within that 7-day window, the transaction cannot proceed. Furthermore, the NAIC Best Interest Standard involves 4 core obligations known as care and disclosure and conflict of interest and documentation. The care obligation requires you to exercise reasonable diligence, while the disclosure obligation requires providing the consumer with a written summary of the product features and your relationship. The conflict of interest obligation mandates that you identify and disclose any material conflicts, while the documentation obligation requires you to keep thorough records of the basis for your recommendation. Remember that on-the-test questions often ask about what must be disclosed regarding surrender periods or tax penalties. You must have a reasonable basis to believe the customer has been informed of these features and that the customer would benefit from the specific features of the annuity, such as tax-deferred growth or a death benefit. Always look for the answer choice that emphasizes the client's long-term goals rather than agent compensation.